Hello, dear family and friends. I'm happy to start this video series on what I call Swing Trade to Financial Freedom. But before we start, please take a moment and read this legal notice. And please know that what we discuss here is only for educational purposes only, and it's not intended to provide you with investment advice or tax and legal advice. And what we're going to do is to look at the charts and understand how a market works, financial markets, and from that to get an idea how they may do the same thing in the future. But that may or may not happen. And so I really encourage you that please paper trade. And when you feel comfortable that you're successful most of the time paper trading, and then if you're going to do live trading, do with a small amount of money, with the money you can actually lose. And what happens with real money, you'll see your emotions takes over. And what we're trying to do here to come up with a plan of action that will show you how to get in and get out of a trade, so it becomes more automatic, so you don't depend on your emotions. But then paper trading will help you get a feel for the market, and live trading, again with a small amount of money that you can lose, will help you to really put your trading plan into action. Now, having said that, let's go talk about financial freedom. And this is our first video. And to a lot of people, financial freedom means you have a lot of toys, big cars and airplanes and what have you, or a lot of money sitting in the bank. And if you talk to an investment advisor and say, hey, I'm going to plan to retire, let's say in 20, 30 years down the road, the chances are they're going to come up with a plan of action for you that requires you save a lot of money over time, so you end up with millions of dollars. So when you retire, you can live off of that money. But realistically, that's not really feasible for a lot of people. And so we're going to take a look at here at different ways that is possible for somebody reach financial freedom. First, by financial freedom, we mean having sufficient income that helps you live a lifestyle you like. Now, for some people, that could be a few $1,000s a month. For some people, it could be a lot more. And so you need to decide based on your current income and what you're comfortable with, and then see which way you like to go to achieve that. Now, some people are business minded and going to start a business, especially nowadays with online businesses. Some are very successful, but it really is not for everybody. For that matter, most businesses, new businesses, fail within the first 5 years. But if you are one of those people who can create a business that provides you the income you need, that'd be wonderful. Now, some people like to have properties and rent them out, have rental income. Again, that's a wonderful way to make your income. But for most people, again, that's not even practical. And it has a lot of problem with rentals too, and depends who rents your place, and having the financial foundation to even purchase the rental properties. Again, but if it's for you, that's wonderful. Now, investments and trading is something really everybody can do, because when you work, you can save some of that money. And if you learn to trade it and manage it yourself, and that's what we're going to be discussing more and more in these videos, then you can actually create a nice source of income for yourself. And it's fun. Really doesn't take too much time, and just maybe a few minutes, half an hour a day. And that could be something that you may want to look into it, because we all have to deal with money anyway. And who's more interested and concerned about your money more than yourself? Now, really, I encourage people, and especially our young people, children, to make saving a habit. It's an old saying goes that says the wealthy works to invest, the non-wealthy works to pay bills, and that's so true. And so, and also we have to really realize that the traditional way of people planning for retirement, which is Social Security, income, and Medicare, it really may not be there in the future. When Social Security was designed, people living maybe to around age 60, 65 and pass away. And also there was a lot of people working and a few people retiring. But over time, what's happened now, people living longer and longer, and less people working, and more people receiving benefits. So 2018 government's annual condition of Social Security and Medicare, they projected that by 2034, Social Security is going to be insolvent. And by 2026, Medicare may be insolvent. And actually, 2018, then they start tapping their reserve because the payroll taxes and interest from the trust funds are not enough to sustain the money that's going out. So then it becomes really important for each one of us to really plan for our future and make sure that we have sufficient income at retirement. So to do that, I really encourage you to treat your finances as if you're dealing with a business. If you have a business, it's very important to know your cash flow. You want to know how much money coming in and how much money is going out. And and of course, then if you are negative or breaking even, then you want to see what's going on. And even if you're profiting, you want to have a better handle over what's coming in and what's going out. And so then one thing to do is to minimize expenses. So like for your home, you can make categories for house, for example, utilities, rental, mortgage, your car insurance, gas, and what have you, maybe your entertainment. And then if you keep track of those expenses, at least for 3 months, and you don't have to be too rigid about it, but it's good to get a feel for the money coming in and the money's going out. And so if you can find ways to minimize expenses, then of course you're going to increase your the leftover, and that's the money is going to go into savings. Because if there's no money here, we can't save anything. Now, I encourage people to have a checking account, and basic checking account used to pay your monthly bill. So you have your income coming in, from work or job or business or what have you, and then you're going to pay your monthly bills. And again, hopefully then by the end of the month there's something left over that can be saved. Now, the next thing I encourage people is to have emergency fund, minimum 3 months. That means whatever your monthly expenses are, once you do your budget, see how much money you're spending each month, minimum 3 months of that needs to be saved. And a good place for that to me is a money market account. You get a little bit of interest. The money is available anytime. If you put it in a CD, it's more difficult to take it out. But here, you can connect it to your checking account. And so the money that you need can come out of here, go to your checking account, or checking account extra left over can come to this money market account. And this is to cover unexpected expenses, car breaks down, or you cannot work for whatever reason. And so that's really important. Now, once that's done, then you start saving for things you want to do within the next 5 years. Maybe you want to take a vacation next year. Maybe you need a car in 5 years. Maybe you're saving to put a down payment on a house. And so this should be a different place that you save money for. And depends how many months or years you have time. Either you keep it in a money market account or a CD, or you can learn to swing trade with it and make that work harder for you. So that's something we're going to discuss more when we start talking about swing trading. Now, your investments, anything is over 5 years, for example, retirement plans, college funds, uh, and everybody should have that. Now, there are two types of basically plans: group plans, individual plans, and you need to really look into see, if you're maximizing your savings. If you're working, sometimes the employer matches your contribution, so you want to maximize that to the point that they do save that. After that, they want to put it inside of an individual retirement account or Roth IRA. And it's important to know the difference between the two. With the traditional uh, retirement plans, you don't pay tax on the money you save. So for this year that you're working, you're lowering your income, so you pay less taxes. But then everything that money that you save plus the interest become taxable when you take the money out. And imagine 10, 20, 30, 40 years down the road, do you think taxes will be higher or lower? I think it's going to be a lot higher. And that's why Roth IRA is such a gift. In Roth IRA, you don't get a tax benefit this year, but everything you put in there plus the interest then becomes tax free. You pay tax on the money you put in there, but all the interest is tax free. And of course, you want to consult a CPA to really understand how much you can save and how does that affect you and applies to you. And so I really encourage people to take advantage of this if they can. Uh, Now, I really encourage everybody to examine your savings and your investments and see how they've performed over the years and also what fees you're paying. Now, I've seen a lot of people have a lot of money inside of their checking account, inside of CDs, in terms of money market accounts. And what people don't sometimes think about is that there is a good, like around average 3% inflation. So if you're not making 3% on your checking account, your CDs or money market that you're using for like a investment vehicle or saving vehicle, then you're already losing money. On top of that, you're going to be paying taxes on that. Like we talk about, checking account is really for paying your bills. Money market is just basically to hold your excess money for emergency funds, and from that, the money to go into your saving accounts or investments accounts and so forth. Now, most people have in their investments mutual funds. And what mutual funds are, they're competing with an index. Indices is like a Standard Poor's 500. You've heard of it. This is 500 major American companies. And so if the market, if that Standard Poor's 500 go up in that particular day, then say market went up, it really shows you the market, how the market is moving. And also they have sectors. There are sectors underneath the Standard Poor's 500, which is really nice. You can also learn to study them and work with them. And there's a Dow 30. You get 30 major American companies. There's NASDAQ 100. These are technology stocks, 100 of them. Russell 2000. These are small cap. And there are hundreds more of these. And every country also have their own ETF. So, for somebody like to invest in a different country, you can use their ETFs. And what's nice about ETF is that you're not dealing with just one stock. You're dealing with a whole basket of them. But unlike mutual funds, they can be traded. You can buy them and sell them throughout the day when the market is open. But with mutual funds, if you want to buy, sell them, you have to place an order with your broker, and then the next day it goes into effect. And there's nothing can do with it throughout the day, and they also have fees. And the thing is that with mutual funds, they're trying to compete and do better than an indices, but most of the time they do not. And so by understanding the indices and also getting a feel for how the market is doing, and for that matter, stocks, like 75% of stocks they're moving in the same direction with Standard Poor 500. So if the Standard Poor 500, so-called the market is going up, about 75% of all stocks also moving up and so forth. So it's important to start getting a feel for exchange traded funds or ETFs or indices. Now, then there are stocks. Now, if you want to trade stocks, it's good really to get a handful of these really good ones, and that way you can get to know them. Every stock, every ETF have their own characteristics, and that's because there's certain people who are trading them day in and day out. And so then you begin to see those patterns, and it make it easier to work with them. And but in the beginning, I really encourage you just work with a exchange traded fund or one or two or three of them, and that's really sufficient. But as you get better, you want to add the stocks to it because with stocks you can make more money, can also lose more money. Then you can start working with them. The other thing it's really important for people to know about is annuities. But annuities are kind of a complex financial instrument. They really need to be understood. And one of the key positions for annuities or characteristics is that you can create a lifetime income from them, and that become a source of income that you can have for the rest of your life as long as you live or for a shorter period of time as you choose. But again, this needs to be understood and then applied based on your needs. Over the years, I have helped many of my clients who are mostly seniors to use annuities successfully and to avoid ups and downs of the financial markets. But again, there are some annuities that are so-called fixed that the market ups and downs does not affect them, but there are some annuities that's called variable, and they are also invested in the stock market and have fees and so forth. Now, if you have existing investments, then you're going to see it's really important to understand and how to manage your investments. We talked about the video on setting up your charts, Thinkorswim platform. I showed you that how over the years market really drops around 40-50% every few years. And now, being 2019, market has been going up almost 9 years, and we have not had a major really a drop. And so it's good to be really aware of what the market is and what may happen down the road and be able to plan accordingly. Now, if you want to start a new investment, like you're a young person, you want to start saving for your future in an IRA or Roth IRA, I really encourage you to start with an exchange traded funds. And there's some really good ones. You can use one or some of them. For example, we talk about Standard Poor 500, which is the market, the Dow 30. By the way, Standard Poor 500 is the biggest market there is. That means it's the most volume traded every day. So it's easy to get in, easy to get out. And the difference between buying and selling is really small pennies. And so this makes a really good vehicle to start with. And also, these major American companies, 40% of them have exposure to other countries as well. So just by having Standard Poor 500, you're already in 500 best American companies. And also, you don't have to worry about the particular stocks having an earnings or having a CEO coming and going. Of course, you still have to pay attention to the news. There are certain news, like when the government talks about changing interest rates, for example, or the unemployment rates and so forth. We're going to talk about those more in the future. But outside of that, pretty much when the market moves, he works a certain direction. I'm going to learn, how to follow this direction the market has. And now, also, as we mentioned, there is a Dow 30, there's technology stocks 100, Russell 2000. Bonds are pretty good to 20-year Treasury. They go pretty much opposite of a Standard Poor 500, not 100%, but quite a bit. And there's also gold ETFs, for example, so you don't have to buy just one stock of gold. There's silver ETFs, there's oil ETFs. So there's plenty of them if you want to have more than one. But really, in the beginning, just one is enough, or a couple of them. And also with the stocks, like I said, just a handful is okay. For example, you can look at Dow and see which stocks. We're going to talk about how we choose them in our next videos, and pick up, a handful of stocks that you like, and you understand the patterns, and work with them. And one simple way to save money is that what's called dollar cost averaging. Let's say you can save $400 a month. You put $400 a month in that particular stocks or ETF each month. You don't even have to worry about it, especially when you first start. You know, you put the money in there, and if the market goes up, great. The market goes down, you're going to buy it cheaper the next month. And so, because you also have years ahead of you, when you buy some cheaper, some more expensive, they're going to average themselves out. That's why it's called dollar cost averaging. And now, of course, once you have certain amount of money saved, then you can start swing trading it. And that way, you can make it work even harder for you. And that's what we want to learn to do as we move forward. Now, when it comes to saving, I call the magic of time, interest rates and compounding. And this is crucial. The more time you have ahead of you, the better it is. The younger you are, when you start saving money, the better it is. Now, if you have investments and you look at them, the chances are, on average, you're not getting more than 5%. Now, last few years is different because markets keep going higher and higher. But over time, you'll see market will drop and average 5-6%. And so if you're making 5%, let's say, and you have 20 years ahead of you, in 20 years, you've saved $173,596,000. Now, if you can raise that up to 25%, in the same time, your money is over $2 million. At 15%, your money is over $500,000. So here I'm trying to show you what the difference time and interest rate and compounding makes. Now, what I want you to keep in mind is what's called rule of 72. What that means is that you get the number 72, you divide it in the interest rate you're earning. So let's say right now you're only earning 1%. And so that means it will take 72 years for your money to double. So if you invest in $1 and leave it there at 1%, it takes 72 years to become $2. But now, if you, let's say, invest in making 6%, and you take 72 and divide it by 6%, then you'll see your money is going to double every 12 years. Much better than every 72 years. And of course, the higher your interest rates are, the faster your money grows. And whatever interest you're getting, let's say you're getting 25%, so you get a standard calculator here. It says 72 divided by 25%. So your money doubles every 2.88 years. And so that's really important to keep in mind, that you want to get as much interest as possible, of course. And that's what we're going to learn about trading, swing trading. All right? So again, if you have any questions, please feel free to email me at swingtrade2financialfreedom@gmail.com. And I do provide a free online webinar Sunday nights, 8 to 9 p.m. Eastern Time. And so if you're interested to attend some of these sessions with me, or if you have any questions, you can email me and I'll send you a link for it. Thank you. Have a great day. And I'll look forward to talking with you soon.